You open the broker's app, look at the chart, and think that the main danger is the market, drawdowns, news, and panic. It seems that money is only lost when everything goes down, and if you choose the right moment, the right fund, the right strategy, then you will finally stop worrying. But there is one problem. The most expensive thing in an investment almost never looks like a danger. It looks like a small change, as a service. Like, well, it's only 1%. And precisely because it sounds innocent, it works like a perfect trap. Imagine two people. Let's call them Artem and Max. Neither of them are geniuses, millionaires, or crypto alchemists. Ordinary adults who have decided that it is enough to live only on a salary and it is time to build a future. Both start out in much the same way. They save every month, don't skip payments, and don't make any sudden moves. Both choose the sensible path. They even read the same tips. Diversify, long term, don't panic, don't chase hype. Both start the same habit. Send money to investments every month, and for the first few years, everything looks the same for them. The amount is growing slowly, but it is growing. They don't feel wow, but they feel like they're doing something right. At some point, they even have the same sense of adult calm. I finally don't just spend, I build. And then 10 years pass. Not 1 year, not 2 or 10. And one evening, Artyom accidentally compares his result with Max's, just out of curiosity, without envy, no drama. Then he sees a strange thing. They earned about the same amount. They invested about the same amount. They were in the same economy. They have experienced the same crises, the same bad years and good years. But Max's total amount is noticeably higher, not by a couple of percent, not just a little bit. And so, that an unpleasant question appears in my head. How so? And here comes the part that many people don't like, because it's not about motivation, not about work harder, not about just believe in yourself. It's about math, about the mechanism, about the fact that Artyom had a piece of his future quietly cut out every year, and he didn't even notice. Because the difference between them wasn't what stocks they chose. And it's not that one person guessed the market better. The difference was in commission. In a commission that sounded like dust. Only 1% per year. One digit, one character, 1%. You hear it and your brain automatically translates once. Like it's a one-time entry fee. It's like you just paid for a ticket, got on a train, and then the train goes on its own. But a commission is not a ticket. The commission is a door that opens every year and takes a part of your result. And the more capital you have, the more appetite she has. It's like a tax that goes up with your success. And the most insidious thing is that you don't feel pain because no one comes to you and says, well, give us the money. It just happens inside the system, somewhere in the background, as if that's the way it should be. And the most unpleasant thing is that many people do not pay this commission for real value. They pay for the feeling that everything is under control, for the beautiful interface, for quiet words, for the feeling that there are professionals working there. This looks like security, but sometimes this is the safe way to lose the most. You can live for 10 years, honestly saving, honestly investing, honestly experiencing volatility, and still lose to a person who did almost the same thing, but just didn't give 1% every year. And it sounds absurd until you see how the compound works. Because the compound is not percentiles, it's a snowball. This is the effect when money starts to grow, not only because you deposit new amounts, but because the previous amounts are already working for you. And the further, the stronger. And here's what's important. The commission doesn't just take a little bit of money. It cuts exactly the snowball. It doesn't cut your first steps. It cuts your future growth explosion. It steals the part of the road where things start to speed up. There is a point that almost no one is aware of. When you pay 1% a year, you don't pay 1%. You pay part of your future, part of your time, and part of your freedom. You pay with what could happen in 10 to 20 years, when your capital would finally become large. And it's like a story where you're told every year, it's okay, we'll just take one coin. But the coin gets bigger every year. At first it is invisible, then it gets annoying. And then you realize that it wasn't really a coin you were giving away. You gave an opportunity. And I know that right now someone has a defensive reaction going on in their head. Alright, but I get the service. I'm getting control. I get advice. I get peace of mind. Yes. Sometimes it makes sense, but more often, the problem is different. People don't even know how much they're paying or what they're paying for. They know the number 1%, but they don't understand that this is not the only figure. Because the real commission trap almost never looks like this. Pay 1%. It looks like this. Pay 1% here, a little more there, another small fee here, spread there, management fee inside the fund, commission for the advisor on top, and in the end, you can't even tell your real figure. You think you're not paying enough, but in reality, you pay a lot, just piecemeal, so that the brain doesn't notice. And this is exactly the situation where you can do everything right in terms of behavior and still lose in terms of mechanics. Because you don't control the market and you control the commissions, this is the only thing in an investment that is almost completely amenable to your decision, and that's why it's so important. Today I want to do one simple thing without shouting, without secret schemes. No promises that you'll be richer tomorrow. I want you to see the mechanism so that you can understand why just 1% is not a small thing. Why the commission is a silent compound killer, and how to check your investment so that you never pay for fog again. Because if you are investing now and you think, well, the main thing is not to panic and hold for a long time, this is true. But there's another truth. You can keep it long and lose it quietly. Not because the market is bad, and because of the fact that your capital has an invisible parasite every year. And let's make a deal right away. I'm not going to tell you that everything has to be free. There is no free service in the world. But there is a fair and dishonest. There are clear and incomprehensible things. There is something that really helps you move, and something that is simply beautifully called. At the end of this video, you will know 3 things. First, why commissions are more dangerous than they seem. Second, where exactly are they hiding, even when you think you've already figured it all out? And the third, how to make a decision so that your money works for you and not for someone else's business model. Because the purpose of investing is not to look smart. The goal of investing is to become freer, and if 1% quietly takes away your freedom, then this is not a small thing. This is the main thing. You have already understood the main nerve of this topic. In investing, you are rarely killed by a bad market. What kills you more often is what looks like convenience. And now, I want to lay out the traps so that you can literally go through your briefcase and see where the money is flowing. Not in theory, but in reality. Because the investment trap almost always looks like a normal thing that everyone does. The first trap is commissions you don't feel. For most people, the commission sounds like a single item in their head, fee 1%, but in reality, the commission is a layer cake. There is a fund commission, there is a platform commission, there is a commission for portfolio management, there is a commission for rebalancing, there is a commission for currency conversion. There is a spread that no one calls commission, but which you pay every time you buy and sell. And the most annoying thing is that many of these things don't look like fees. They look like, well, that's how the market works. And when you can't see them, you can't control them. Here's a quick test. Right now, without Google, can you tell us what your total commission per year is? Not like there is 0.8%, but really, fund plus platform plus any services. If you can't name a number, you're already trapped because you're paying for something you can't even measure. And here it is important to understand the mechanism. Commissions are not killed because they are expensive. They kill because they cut out the compound. They cut out future growth, and they do it quietly. And the further you go, the more painful it gets. Because your capital is small in the first few years, and your losses are not noticeable. And then the capital becomes large, and that's when the real robbery begins, just at the moment when most people first have a chance for real freedom. The second trap is active management as a sedative. There's a simple psychological hook. We like to feel that someone is watching. It's like the money is being looked after, like there's an adult in the room. This is why many people choose active funds, strategies, and experts who know how to avoid crises. It always has the same message. The market is dangerous, but we are smarter. We will tell you when to exit, when to enter, and how to protect your profit. The problem is that over a long distance, active management often sells not the result, but the sense of control. Because the reality is boring, most of the time, smart maneuvers do not provide a stable advantage, but they almost always add costs. Commissions are higher. There are more transactions. Taxes appear earlier, and if the result accidentally turned out to be better in one period, it turns into a legend, which is then sold for the next 10 years. You need to understand one thing. Even if an active manager sometimes overtakes the market, he must overtake it enough to cover commissions and errors, and do this constantly. This is an extremely difficult task, and selling a sense of security is easy. The third trap is tax invisibility. People think about taxes when it's too late. When they sold, they recorded a profit, received an invoice, and suddenly it turned out that part of the profit was not yours. And here, many people make the second mistake. They start to fix, re-enter, transfer smartly too often, but frequent sales turn investments into permanent tax micro losses. This doesn't mean you can't sell. This means that every move has a price. And if you move just because you're anxious, you're paying for your anxiety with real money. The fourth trap is diversification that looks smart but makes it worse. There is a kind of portfolio that looks like a professional one. 23 funds, 12 thematic ETFs, a little gold, a little technology, a little to be, a couple more for growth, another for protection, and in the end, you can't explain what you have inside. You seem to have reduced the risk. In practice, you often get duplication of the same companies in different funds, a lot of commissions and spreads, the complexity that makes you more likely to make mistakes, and most importantly, the lack of a clear strategy. When a portfolio is too complex, a person starts referring to it as an emotional object. It checks constantly. It constantly improves. It's constantly changing. And changes are transactions. This is a commission. These are taxes. These are losses. Difficulty almost always creates movement, and movement in investments often equals leakage. The fifth trap is chasing profitability as a form of complacency. The most popular thought when money is tight is, I need a high percentage, and the person begins to look at the most vivid stories, the loudest charts, the most daring assets. There is always a feeling that this is the way out, because boring growth seems too slow. And then one of the most dangerous psychological mistakes is triggered. You start to choose not what works, but what promises to remove the alarm faster. You choose hope, and the market always sells hope at the highest price. This is a trap because people often take risks not when they are comfortable, but when they are in pain. They enter at the peak of their emotions. They buy something that has already grown because the brain sees confirmation. Look, it works. And then the market does what it always does. It rolls back. And the person can't stand it. He goes out and records the loss, and he convinces himself that the investment is not for him. Although the problem wasn't the investment. The problem was the psychology of entry. The sixth trap is mixing investment and rescue. This is a subtle thing. When you invest because you want freedom, that's okay. But when you invest because you urgently need to get out of the financial hole, investing becomes a lifeline. And then you start expecting something from the market that the market didn't promise. Quick solutions. And you turn a long game into a short one. You're getting nervous. Check it every day. React. Search for signals. Subscribe to analytics. Try to predict. And here's the big twist. The market doesn't destroy you. Necessity destroys you. When money is needed urgently, you are not an investor. You're a person under pressure, and the pressure pushes you to make mistakes. Therefore, any healthy strategy starts not with the choice of a fund, but with a safety cushion, so that the market is not your oxygen. If you invest money that you may need tomorrow, you will always make decisions out of fear. The seventh trap is influencer investment. This is a separate kind of trap because it plays on comparison. You scroll through social networks, see how someone earned, entered on time, found a coin, made X's, and the brain concludes, I should too. Not to get rich, but to stop feeling left behind, and that's where you start buying non-assets. You start buying a sense of belonging to the successful ones. You're buying a ticket to someone else's story. And the dirtiest part is that social media almost always shows the winners. The one who has lost is usually silent. All you see is the window, and you start to think that this is the norm. And when you don't succeed, you think you're the problem. Although the problem is a distorted picture of the world. The eighth trap is passivity, which is actually also a risk. There are people who are afraid to invest and keep money in the cash for years. They think it's safe. This is the other extreme. It's also a trap, because inflation and lost returns are also losses, just invisible, and the brain does not feel them. He doesn't see the red numbers. He sees stability, and calms down, and time passes. And then there comes the moment of buying an apartment, a car, moving, and suddenly it turns out that stability has not saved anything. So you have two opposite traps, risk for the sake of emotions and safety for the sake of emotions. Both are driven not by logic, but by fear. It's just that the fear is different. And now, let's make a practical block. Right now, if I were sitting next to you and we were looking at your investment, I would ask you 4 questions. They are simple, but they reveal almost everything. First question, how much do you pay per year? Not roughly, but precisely. If there are no numbers, find them. If it is difficult to find it, this is a red flag. The harder it is to find, the more often extra fees are hidden there. Second question, why do you have each asset? If you can't explain the role of an instrument in 10 seconds, it's probably bought by emotion or noise. A portfolio without clarity almost always leads to unnecessary actions. Third question, what happens if the market falls by 30%? Not, I'll keep it, but really, can you handle it? You won't need any money. Aren't you going to start panicking? If the answer is not sure, then the risk is too high for your psyche, and you are trapped again. Because a strategy that you can't handle is not a strategy. Fourth question, do you invest on a schedule or based on emotions? If you enter when it's scary or when things are growing, you're not playing at investing, you're playing at feeling, and feeling almost always loses out to math. That's the main point of the main part. The investment trap is not one specific tool. This is a set of mechanisms that turn your energy and hope into someone else's profit. Sometimes through commissions, sometimes through taxes, sometimes through psychology, sometimes through comparison. And the most dangerous thing is that all this can be done correctly by feeling. You can feel responsible, mature, and rational while paying too much, complicating things too much, moving too often, and waiting too fast. And this is good news, because it means you don't have to guess the market to get stronger. You need to clean up the leaks and build a system that you can handle. And here's what's important. This topic is not about becoming the perfect investor, and it's not about finding one magic strategy that always wins. Investing almost never breaks people down because of the market. They break people down because of leaks and emotions, because of a commission that you didn't notice, because of the risk that they took, because it was a shame to be behind, because of the extra movements that look like I'm driving, but in reality, we're just anxiety. So the final thought is very simple. You don't have to be a genius. You need to be steady. Your strategy should be able to withstand your psyche. Your portfolio should be so clear that you can explain it to yourself in 2 sentences. And your decisions should be written in advance so that you do not make them in a moment of fear or euphoria. If you want super practical, here's a minimal anti-trap kit that you can make now. Check your commissions and remove anything you can't explain. Simplifying a portfolio is almost always about improving quality. Determine the share of risk so that you can really withstand the fall and do not sell at the bottom. Make a cushion so that the market isn't your oxygen. And choose one simple regular rhythm. Invest according to your schedule, not according to your mood. Because the mood changes and the schedule builds results. And the most peaceful thing is that you can afford to stop comparing your life with someone else's showcase. They always show X's, but almost never show the price of these X's. Real financial freedom looks boring. This is when you have few leaks, a lot of clarity, and the system works even when you are tired. If you like this analysis, please like and subscribe.